Hi guys, good afternoon. Today I want to touch on a subject I'm particularly passionate about, and that is real estate as a business. If you are going to get a property, be that a residential or commercial property, if it's not your primary residence where you live, in the case of residential properties, you are likely looking at it as an investment property. Right. Now, if you're looking to get an investment property, you'll be thinking about how it makes sense from a business perspective, or from a financial perspective. So today, I thought we should delve into the numbers of real estate. How do you determine that the property you're looking to acquire or the property you have on your hands is a good investment as a business? Like every other business, real estate is a numbers game. The numbers don't make sense, you're either losing money or you're leaving some of it on the table, and you don't really want to do that. So you want to get smarter about your investment decisions and make sure you're getting the right value for your money. So that's what we're going to dig into today. Okay, now before we get into the nitty-gritty, I would like us to get an understanding of the differences between the different types of real estate properties or real estate investments, right? It's fairly easy to differentiate between residential and commercial property, but not so much between commercial and industrial property. So, as a start, I'd like us to delve into just a brief understanding of the difference between commercial and industrial property, because that also kind of has a bearing on how you work out what is a sound investment in either asset classes. Okay, so let's start with commercial. A commercial property is a property that you acquire for the sole purpose of generating a profit. That is a non-residential property. So if I buy a shop or an office block or a gas station, things like that, that is a commercial property. I'm looking to acquire that property for the sole purpose of it generating me a profit. Industrial property, on the other hand, is for different purposes. It's not strictly for profit making, it could be for other purposes. Typically, this is for manufacturing use. It tends to be for distribution, warehousing, that is, or even other production, like refineries. Those are industrial properties. Okay, few examples: factory, industrial property, truck shops, industrial property, warehouses, industrial property, and so on and so forth. They are not commercial properties. Okay, now speaking strictly for this particular discussion, we're going to talk about commercial and residential properties. Residential properties, of course, are properties that are used for your dwelling. It could either be for your personal habitation or to rent out. Those are residential properties. Right. So having said that, we dig into it. How do I know that the property I have acquired or the property I am acquiring is a good investment from a financial perspective? There's a few things to tell, and we're going to start with commercial properties. In commercial real estate, there is something known as a cap rate or a capitalization rate. In simple terms, a cap rate is a rate that is used to determine the value of an investment, right? That is a cap rate. There's also something known as your net operating income. Your net operating income is basically the difference between your income on a commercial asset, and your expenses. Okay, so the difference between how much a commercial asset is giving me in income, in revenue, and how much I'm spending on that particular asset, that is the net operating income. I'm mentioning the net operating income because it's what we use to determine the cap rate, which in turn tells us the value of our investment on that particular commercial property rather. So how do I determine my cap rate? And how does the cap rate tell me whether or not I'm making a good investment decision? Simply, to get my cap rate, I would have to take my net operating income, okay? My net operating income, which is the money that the commercial property is giving me, and subtract the expenses on that property and divide it by the value of that property and multiply it by 100. I'll say that again. My cap rate. How do I work out my cap rate? I get my net operating income, which is simply the income I'm earning from a property minus the expenses on that property, okay? And then I divide that by the value of the property. That could be either the market value or the appraised value, like the valuation that's been done on the property, or the sale value of said property. Divide the net operating income by said value and then multiply that by 100. That gives me the cap rate in percentage terms. Okay, for example, if I have a commercial property that generates me 600,000 kwacha a year, okay, 600,000 kwacha a year, and the value of that property, okay, if I've had the property appraised and the value on said property is, say, 14,000 kwacha, 14 million kwacha rather, my cap rate works out to 4.3%. So what I've essentially done there is I've taken 600,000 kwacha, which is my annual income on that property, okay? That's my net operating income after I've taken out my expenses from the income, okay? I've taken that 600,000 kwacha, I've divided it by the value of the property, which is 14 million kwacha, and then I've multiplied that by 100 to get 4.3%. That is my cap rate. Okay, now a few things to understand about the cap rate. The higher your cap rate, the higher your returns on the property. However, the riskier the investment as well. The lower your cap rate, the safer the investment on the property. However, the lower returns as well. So you get asked then, what is a good cap rate? It depends on your risk appetite as an investor. Okay, if you want higher returns but a riskier property with a riskier investment profile, you probably go for the one with the higher cap rate. If you want a safer bet, you probably go for the one with a lower cap rate. It's just important that you know that what either cap rate means for you personally as the investor. Okay, now that is a little bit about the cap rate and commercial properties. A few things to remember about cap rates. Cap rates are influenced by a few factors. Some of them are macroeconomic, interest rates and what have you, which is beyond the scope of this video. But the more immediate ones are some things that you could do to enhance the value of your property. Number one, the location of your property. The location of property is very, very important to the rate of return you get on it. Number two, the aesthetic of the property. Okay, how it appears. Is it visually appealing to would-be tenants? Is it in a state of disrepair? What sort of state is your property in? The third one, your financing options. We won't dig into that for now as well. So those two things, the location of your property as well as the state of the property are important to determining what sort of cap rate you get on said property. Okay. A few limitations on the cap rate. Okay, a few things to understand about the cap rate as well. there are a few limitations. It's a good metric to use to measure property, but it doesn't tell you everything about said property. And what are those things that are worth remembering? Number one, there would be appreciation of a property. Okay, so if I have a property today that is worth, say, 16 million kwacha, there's no telling what it would be worth in 5 years. Okay, so my cap rate today would be a guide based on the value of that property today. However, if that property appreciates sharply in a few years, then all of that changes. Okay, so whereas the cap rate would be a useful guide today, it would be helpful to keep in mind that that thing could change. The appreciation of the property could change that particular value, and then that changes my cap rate as well. Conversely, the depreciation of the property. Okay, that is commercial real estate. Moving on to residential real estate. In residential real estate, you typically have what they call your yield. Okay, rather than a cap rate, you have a yield. A yield is basically how much you hope to recoup from an investment over a given period of time. Okay, and how do you determine your yield? Very simple. You get your rent, your annual gross rent. Okay, so for example, if I have a flat paying me 6,000 kwacha a month, okay, I spread that 6,000 kwacha over 12 months. That would be my, rather, I don't spread it, I multiply it by 12 months. That would be my gross annual rent on that property, which would be 72,000 kwacha. So 6,000 by 12, that would give me 72,000 kwacha. That is my gross annual rent on that property. So I get that gross annual rent and divide it by the value of the property. Whatever I for instance acquired the property for. So if I acquired it for 2.4 million, I get the 72,000 kwacha a month and divide it by, a year, 72,000 kwacha a year, and divide it by 2.4 million kwacha, and then multiply it by 100 to get my annual gross yield. That is the annual gross yield, not your net yield. Okay, to get your net yield, which will be the more reliable metric, you then have to subtract your annual expenses on that property. So for instance, if you took out a mortgage, that's an expense. If you're paying land rates on it, that's an expense. If you you have insurance on a property, that's an expense. If you're paying a property manager, that's an expense. Maintenance, gardening and so on and so forth, that's an expense. So your gross annual yield, you subtract your annual expenses on said property to get your net annual yield, which is what tells you the value of the investment on a residential property. Okay, what is a good yield? Typically, a good yield is between 7 and 8%. Okay, 7 and 8%. You're looking at a good yield on a residential property. It's a good indicator the investment is worth making. Like commercial property, there are things you could do to enhance your yield. Number one, you could keep reinvesting in the property. Do not let it dilapidate too much. Number two, look at a comparative market analysis. You want to make sure that the rent you have on your property is at par with what the market is asking in your area and your property profile. A common mistake real estate investors make is to set their rents too high or too low on particular properties. I explain what both things mean for your property. If your rents are too high, if the rent you're asking for is too high, you have shorter stays on the property and a higher lower occupancy rates rather. Okay, because clients will know that they have similar properties in the area fetching far less than you're asking, in a similar condition. So when they wake up to it, they'll leave. and where to go around that. Look, this person asked for, the rentals are too high. Maybe you want to look elsewhere to get value for your buck. Okay, if the property is if your rent is too low as well, you are doing yourself a disservice, because then you're probably spending more on maintenance. You're probably spending more in your expenses on the property than the property should otherwise fetch, which affects your profitability. So those two things worth remembering as you are looking at your investment options in residential property, as well as the yield. Okay, so just a quick recap. Commercial property, you're looking at a cap rate for the property. How do you get the cap rate? You get your net operating income, which is the difference between how much the property is earning you and how much you're spending on the property. Okay, that's your net operating income. You get that figure and divide it by the value of the property. The value could be, the appraised value. You could get a valuation done on the property to give you an idea of what the property is worth. It could be a sale value. If you recently bought the property, you would know how much you bought it for. Or it could be the market value. Okay, so you get that value and you divide it. You divide the NOI, the net operating income, by that value, and then you multiply it by 100 to get your cap rate as a percentage. That should give you a guide as to what sort of investment that would look like. The higher your cap rate, the higher the returns on the property, but also the higher the risk on said property. The lower your cap rate, the safer the bet is from an investment perspective, but also the lower your returns on the property, which means it will take you longer to recoup your investment. In residential property, you're looking at your yield. How do you determine your yield? You get your annual gross rent on the property and divide it by the value of the property and multiply that by 100. Okay, that will give you the gross annual yield. However, to get a more accurate metric, you'd need to determine your net annual yield. So when you get your gross annual yield, you subtract now your annual expenses on that property from that figure to determine how much it's actually netting you. Okay, fantastic. So that would conclude our video for today on how to determine a good investment property. What is it that makes a property a good investment from a financial perspective? Because real estate, like any other business, is a numbers business. If the numbers don't make sense, you are losing money. And if you're losing money, you're not doing yourself any favors. Thank you so much for stopping by. Before we go, guys, I went to school to study this so I can bring it to you for free. So I'm asking you for a favor in return. Please click the subscribe button and share this content so we can keep more and more of it coming your way. I appreciate you stopping by and enjoy the rest of your day.